Hey Bowtie Nation, Joseph Hogue here with a very special matchups video. Steven in our Facebook group suggested a this versus that theme, matching up some of the most popular stocks against each other to see which is the best investment. And this week, we're doing all electric vehicle stock comparisons, comparing the most popular EV stocks to buy, including Tesla, NIO, Lucid, and Rivian in a head-to-head grudge match for the best investments you can make. If you want to suggest some stocks to compare, join the community by tapping that subscribe button and leave me a message in the comments below. We're getting right into our EV stocks list, but first I want to highlight a special offer from MooMoo, one of the investing platforms I use to trade stocks, options, ETFs, ADRs, and OTC shares in multiple markets. Whatever it is, the MooMoo app has the tools you need to find investments and the strategies, and is available for US, Singapore, and Australian users. I used a new feature, the industrial chain mapping, for research in this video. It's a feature I've been wanting for a long time, and a great way to really understand an industry and the key players. Clicking through the electric vehicles here, we see each step in the supply chain, from battery production to electronic controls, circuits, and vehicle production. And clicking through any of these is going to show you all the companies in that stage and which stocks to research. For US users, sign up to MooMoo now and get up to 17 free stocks worth up to $2,000 each with your deposit of $1,000 to invest. That's a free stock just for opening an account, 6 more when you deposit $100 and start investing, and up to 10 more free stocks if you deposit $1,000. And for my Aussie mates, Australian users can get up to 110 AUD worth of cash coupons to be used in trading with terms and conditions. Even if you don't think you'll use the app, use the link I'll leave in the description below for your free stocks and try it out. Let's get started though with the startup EV stocks, Lucid Group, ticker LCID, and Rivian Automotive, ticker RIVN. And I want to look at two things when I'm analyzing these stocks. First, I want to look at the most recent quarterly earnings. Now, each of the electric vehicle companies reported their fourth quarter and full year results recently, and it was a big steamy pile of bad for everyone. It was a tough quarter for EV stocks, but more than just looking at these numbers, I want to see how each company is managing that environment. There are some common problems across the entire group, and I want to invest in the companies that are dealing with those. I'll also be looking for any longer-term strengths in each company, which might have a competitive advantage in the group to drive those longer-term profits. First, we have Rivian, reporting production just over 10,000 vehicles last quarter and 24,300 for the year. Now that brought in revenue of $663 million, which just missed expectations for $717 million, but the company did beat on its earnings, narrowing the loss per share of $1.73 versus a $1.91 estimate. Why the shares plunged 18% on that news was on two factors that are really hitting the entire group. Rivian is struggling with some supply chain issues, not able to get the parts on time, and noted that it lost multiple days of lost production due to supplier shortages through the quarter. It expects those supplier issues to continue through this year and updated its production forecast for just 50,000 vehicles. Now that is double last year's production, but was well short of the previous estimates for 63,000. The other issue here is inflation and those costs. The cost of production jumped 280% in the fourth quarter from the year before to $1.7 billion. So even though its revenue grew 12-fold, the cost of goods sold was over $1 billion more than that. On those runaway costs, the company burned through over $6.4 billion in cash flow just last year. It's still got about $12 billion in balance sheet cash, but it's likely going to need to raise funds next year and dilute shareholders more. On the upside, Rivian did announce its Max Pack battery variants is going to be available for the pickup and SUV models by fall of this year, so that's increasing the range by about 50 miles each. For the Lucid Group, ticker LCID, its loss narrowed to $2.56 billion on revenue that jumped 22-fold to $608 million. And the company reported production of 7,030 vehicles last year and guided to nearly double that, 14,000 this year. Just like Rivian though, that missed expectations for 21,000, so with Lucid also blaming those parts constraints as well as a weakening economy. Now Lucid was only down about 6% on this report, but one thing worries me a little bit more here. The company reported 28,000 reservations as of late February, but that was down from 34,000 at the end of September. Now it only delivered 2,000 vehicles, so that means another 4,000 customers called up to cancel. Lucid EVs start around 87,000, with some well above 100,000 price tag, so that recent price competition from Tesla and Ford could be hurting the sales here. Lucid did announce a limited time $7,500 discount on some of its models, but might need to cut further later. On the cost side, the cost of goods sold for Lucid climbed 307% to $615 million during the quarter, well above the $257 million in sales it booked. So like Rivian here, it's costing more to produce those cars than they're getting when they sell them. This doesn't even include operating expenses of $390 million, so we're going to have to see some major growth continue to even approach that profitability. Balance sheet cash shrank to $1.74 billion last quarter from $3.9 billion in September, and the company already announced in November that it was going to have to raise $1.5 billion from this year, most of it from its majority owner Saudi Arabia's public investment fund, but I'm thinking more funding is going to be likely than not needed next year as well. And we're starting to see the big problem for these newer EV companies is because they're just developing the batteries and production process, their capital expenses are huge here. It's the same problem Tesla went through more than a decade ago and makes it very difficult targeting anything but the high-end luxury market. Against Tesla's Model Y, retailing for about $55,000 after its price cuts, Rivian's R1S is $78,000 and Lucid's Air Pure prices at $87,000 each. Here we see production cost estimates for per vehicle by Morgan Stanley with 2022 estimates in blue, and you can see even at those luxury prices, Lucid, Rivian, they're both losing a lot of money on each car that they sell, while Tesla has approached that point where it can sell into that middle income market. Selling a 100,000 electric vehicle might have worked in 2021, but not heading into a weaker economy and with a price-conscious consumer. Higher interest rates sparked an affordability issue last year, which was met by price cuts and competition this year. Now it's all running smack dab into a weakening economy. What surprised me here is very interesting that we see a much lower valuation for the shares of Rivian versus Lucid. After the sell-off, shares of Rivian trade for just 10.7 times on a price-to-sales basis, and because it has the lower debt also, an enterprise value of just 3.8 times. Now, it's not exactly value stock territory, but it is less than half as expensive as the shares of Lucid Group. And beyond the lower valuation, Rivian is just much further along in that production development, with estimates for 50,000 vehicles this year versus just 14,000 for Lucid. You get to that level of production, and I think Rivian really starts to optimize its costs and push that profitability. They won't get there this year, but it is going to help them lower that price tag and stay competitive, while Lucid is probably going to struggle with the cash burn. The choice is clear in this group. I'm going with Rivian. We've got two more EV stocks to watch, Tesla versus NIO, but the perfect portfolio means cash flow as well as growth stocks like these. Check out the video here for the first in our perfect dividend portfolio series and 5 stocks with some of the highest dividend yields around. But onto our comparison of those established EV companies, NIO Inc., ticker NIO, and Tesla, ticker TSLA. For its quarter, NIO reported deliveries jumped 60% to over 40,000 vehicles and a 62% increase in revenue to $2.3 billion. For the first quarter, the company expects revenue as high as $165 million and for 33,000 deliveries, up 28% from a year ago. NIO is still targeting that premium market segment in China with a retail price starting at $46,500, but is launching a mass market brand in 2024 that could really ignite sales, something we saw in Tesla just a few years ago. Something really interesting about NIO is it's working on a battery as a service model, giving customers the ability to swap out their batteries to supplement charging. It cuts the purchase price by as much as 30% and helps limit that mileage problems that we're seeing here in the US market. The company is targeting 3,000 of these swap stations in China by 2025, with another 1,000 outside the country. China has been an early adopter of the electric vehicle technology through a regulatory push and charging infrastructure, and is estimating 30% of 2025 car sales to be an EV versus just 10% in the US according to IHS Markit. While Tesla has a strong presence in China, it's always going to be at risk as an American company versus the domestic favorites like NIO. Now, we did see the same inflation and cost pressures at NIO as we did with the startups. The company's gross margin, that profitability between revenue after this cost of goods sold, plunged to just 3.9% from 17% in the quarter the year before. So costs are going up everywhere in the space, but still it only represents an increase of 87% on their production costs, much better controlled than we saw with Lucid or Rivian. On to Tesla though, and the best earnings report of the four, with shares actually up 11% on the day. The company announced revenue of $24.3 billion, which was up 37% from the year before, and gross margin of 24%. So while the pace of sales is slowing a little bit from that 50% plus rate that we've seen over the past few years, that gross margin is really high compared to its competitors. Tesla's competitive advantage here is in two facts. And first, its size gives it that power over suppliers. It's able to get those lower prices and has been able to get preferential delivery. So if suppliers are constrained, they're going to fill Tesla's orders first, and other EV companies are just going to have to wait. Its second advantage here is that Tesla already has worked through a lot of the growing pains that we're seeing in these other car makers. It wasn't long ago that Tesla was wildly unprofitable, only producing 3,000 cars in 2013 and posting a $74 million loss for the year. It's now had 20 years to build up to that size. That brings it those economies of scale and to work out the production process to make less expensive cars. Tesla has given a 2023 production guidance for 1.8 million vehicles. And here Tesla also has its other revenue drivers, like the Megapack, which posted revenue up 152% in the fourth quarter, along with its other developments in self-driving, solar, and eventually an autonomous taxi service. Because of the capital constraints and that earlier stage development, most of these other EV companies just can't afford to split their focus into other projects like this. So these projects are currently unprofitable for Tesla, but in a few years they could be major profit drivers. On the valuation side, this one was a much tougher call than comparing our startup EV stocks. While Tesla doesn't have that margin problems that we saw with NIO, the Chinese EV maker is trading at a steep discount to its US competitor. This is an EV company growing sales at 62% a year and producing more than 120,000 cars, trading at just 2.5 times on a price-to-sales basis. And Tesla, while it's much more profitable, is trading for more than 3 times as expensive at 7.9 times sales. Of course, a lot of NIO's valuation is just that discount for Chinese stocks. Investors just don't want the geopolitical risks that could lead to the company delisting from the US market, or if the government interferes or whatever. I do believe NIO is very close to that point we saw with Tesla just a few years ago, where production scale gets to that tipping point and costs start coming down quickly, and the company jumps into that stronger profitability though. That, combined with a still solid growth and the favorite in the world's largest EV market in China, it's hard to say that the reward is not worth the risk here. Now that said, I personally do prefer Tesla on this one for its greater scale and margins. And Tesla has just the lowest cost of production in the group, and it's going to be able to use that to compete on price and probably take market share over the next year as customers get more price conscious. 2 is Tesla is already developing a lot more levers for profit. Yes, NIO is also developing its self-driving and auto-taxi features, but it isn't quite as far advanced in both of these projects, and both are well ahead of those startup EV makers that just can't afford to split their focus. I've got to give the win here between Tesla and NIO. The edge goes to Tesla here, but I think you can have a stake in NIO for that potential upside to growth. Barring that big lose-all scenarios with the Chinese government, shares of NIO probably do produce the better return, but there's always that risk. Overall here, I'd say Lucid is easily the weakest of the group. Rivian is suffering from the same startup problems, but is much further along in production and a much better valuation. NIO could produce the highest return, but that all-or-nothing risk makes it a question mark for anyone other than those with a high tolerance for risk. Tesla, though, is priced more expensively, especially after doubling in price this year, but is the go-to leader in EV stocks. Remember to get your free stocks on the MooMoo app with the link below, or click on the video to the right for the first in our Perfect Dividend Portfolio series, helping you create the perfect portfolio for constant cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.